I'm Charlotte McLeod with the Investing News Network, and here today with me is Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners. Just a reminder before we get started that if you enjoy this interview, make sure you hit the like button and subscribe to our channel. Eric, thank you so much for joining me online once again. Great to see you.
Happy to be with you.
Yeah, really great to have you back. And we last had a chance to talk a couple of months ago, back in January. You gave us a great overview of what's going on in oil and gas. But of course, a lot has changed in the months since then with the start of the war between Russia and Ukraine. So I want to start there. I know you said online that when it first came up, you thought it was, a little bit of a distraction. And I want to ask when that changed for you. When did you start to think, okay, this is something that we really need to pay attention to?
Yeah, it's a good question, and it is a good point to raise, because initially I did view it as a distraction. My concern was it would take investors' focus off of what I thought really mattered, and that was we had demand surging, recovering back to now higher than where it was pre-COVID-19, the lack of U.S. shale hyper growth, still growing 800,000 to a million barrels per day this year, but not keeping up to demand pace. We thought that OPEC would be exhausting spare capacity by about the summertime, and then the global super majors haven't been investing for late years. So that's kind of like an ongoing part of the narrative. And so what my worry was that oil was going to rally. There's at the time, is there political risk premium this or not? It would make people say, well, geez, oil's up because of this war or conflict. Therefore, when it ends, there goes the energy trade, and why should I be buying an energy stock? And so my goal at the time was really to focus people's attention on what then I thought really mattered. As my thinking has evolved, I think the biggest impact of the conflict has been fast forwarding the arrival to what I thought, and I've been writing about for a long time, is the inevitability of too many years of underinvestment, too many years of vilifying a sector, too many years of the pressures of ESG investment and divestments, and there's just this massive culmination of all of these factors that is resulting in an energy supply crisis, which again I've talked about for a while now, but I think to the masses it's a lot more readily identifiable. And so I would say it's been a good month, give or take, something like that. It probably took me a few days to appreciate, okay, sanctions, way more impactful than anybody thought. Well, what does that mean to the second largest oil exporter in the world? And more importantly, what are going to be the longer term impacts of this? This is not just a, peace breaks out tomorrow and, suddenly Russian exports who resume. There are long-term impacts, which took me a little bit of time to fully appreciate.
Well, yeah, and I think we all had to kind of adapt to the narrative as it was going on. So that makes total sense to me. I wondered if we could talk a little bit about those sanctions. So the impact of the sanctions on Russia, how much Russian supply has actually been sanctioned out of the market at this point? What's going on there?
Yeah, so you've got official sanctions, and then you've got well, we can't possibly justify importing oil to our electorate because we've made the connection that every barrel of Russian oil is revenue to Russia that's purchasing cruise missiles and killing innocent kids with. So that connection's been made. So you don't need official sanctions. Right now, to get real-time data on this is really challenging. I was checking with Kepler, which is satellite imagery. The range that I'm seeing is anywhere from 1.5 to 2-ish million barrels per day of actual impact now, but it's more about the impact in April and ongoing. So some of the big storage draws we've been seeing in the US, that has no impact yet of the impact. And so when you look at sanctions, there's the immediate impact of, well, okay, we're already structurally undersupplied, and we're going to remove, the IEA said, up to 3 million barrels per day, I believe, starting in April. But the really question is, okay, well, if peace breaks out, we're all praying for that. What happens? Do sanctions come back online if there's not regime change within Russia? So the answer is probably not, right? So you're removing millions of barrels from a market that was already undersupplied. And then the extension to this is, well, what's the medium to long-term impact when the BPs, there's a long list of companies that have walked and have taken multi-billion-dollar write-downs. Well, are they going to jump back into Russia, the day after peace breaks out? The three biggest service companies in the world have either left or they've said, okay, no new work. And prior to this conflict, there were stories, and they in fact had a commentary from either the energy minister or the under energy minister in Russia saying, we're actually reaching peak productive capacity. And so when you remove Western service companies and you starve it of capital, because a lot of the revenue, you know, where it's flowing, so like the oil revenue, you know, where it's flowing to, you know, it's arming the conflict. What are the natural declines going to be in Russia? And so it's much more than just this short-term impact. There's probably going to be a permanent impairment on the productive capacity of the world's second largest oil exporter in a market that was already meaningfully undersupplied with inventories falling the fastest pace in history. And so this setup now, and especially heading into the summertime, is like uber bullish for oil.
Yeah, I want to talk a little bit more about Russian supplies. So we know that there's sanctions. Does that mean that supply just sits there, or is there a possibility for, you know, maybe a less scrupulous buyer to come in and say, okay, well, they don't want it, but I'll take it?
For sure, China is buying every barrel that it can. You know, it's trading at about a $30 to $32 differential or discount to Brent as of last night or this morning. So for sure they're taking. But then there's infrastructure constraints where if you're moving 2.5 million of official exports and China's buying some of it, how much? An estimate I saw from Energy Aspects this morning, I think it was about 500,000 incremental. So there's still a big quantum from, you know, Western society that's saying we can't justify buying your product anymore. And so it's again, you know, we were already in a structural bull market before the conflict broke out. And what this is doing is it's fast forwarding us arriving to the inevitable conclusion, but it's also creating a more of a bullish undertone because now you're impairing the productive capacity of one of the biggest oil producers in the world. Like we didn't need, as an investor, purely looking at this through the lens of investor, we did not need a conflict in Ukraine with Russia to, you know, be putting us into one of the most powerful bull markets in modern history. Like that's where we are today. So this has just been additive to that.
Okay, and you know, you've talked to us previously about the three buckets that you look at when it comes to supply, which were US shale, OPEC, and the rest of the world. From what you've told us before, none of them really have much ability to ramp up from where they are. So I wondered if you could talk a little bit more on that, because of course, with Russia sanctions going on, people have been looking more at, you know, other places and what they can do.
Yeah, and you've had the Biden administration call and, in fact, invite U.S. shale executives to the White House a week or so ago, saying, like, you can imagine what the conversation was like. You know, we've got a midterm coming up, I think, in November. Massive inflationary concerns, pressures. You've got one of the biggest inverse correlations to presidential approval ratings is the gasoline price, and so they're under enormous pressure. So after, you know, for years, certain politicians saying that, you know, executives, oil executives should be thrown in jail for climate crimes. Now those very same people are going to those executives saying, please really help us out. Challenge with that is the owners of the businesses, shareholders are the ones who dictate strategy in the long term. Because if shareholders want one thing and a CEO wants something else, then they have the ability to fire that guy and, you know, he'll lose out on his $15 million per year job. And so when we look at the PTSD endured by energy investors during what was the worst bear market in history, we're just getting over that. Like, it was traumatizing, the incineration of almost $1 trillion of shareholders' equity. And so what's my willingness to have one of my companies go, you know, go drill, baby, drill, grow oil production, because I know exactly, and I can still feel it with every fiber of my being, the pain that we experienced because of that. And then I look at valuations and I say, well, you know, using $100 oil, stocks are trading at a third of historical multiples and trading at a 29% free cash yield. So how do you justify growing when the best investment with your cash flow is to make a free cash flow and then use it to buy back your own stock? And so there's a mismatch between what the administrative wants out of job preservation and what the owners of shale companies want. Let's say I'm wrong. Let's say shale companies want to go. There's massive structural deficits in labor, steel tubulars, frac sand, high spec rigs. So there's gating factors. I think it was Devin at a recent conference said, look, there's a 6 to 9 month lag. If you want to ramp production, you've got 6 to 9 months because of those gating factors. I've got companies in Canada saying, you know, they send their crew out to the steel mill to pick up their tubulars, like the casing, they're kind of important to drill a well, and it's not there. Like, there's so many things are in shortage that even if companies wanted to defy the demands of their owners, there's natural gating factors. And so why is that important? We've had global inventories fall by the fastest pace in history. That's using Kepler data. If I just use IEA data, which is more mainstream, it's more accessible, and it's a heck of a lot cheaper. What that shows you is that inventories today are in deficit to where they were in 2010 to 2014. And the reason why I cite that is that was a 4-year period where the oil price averaged $100. Why is it way more bullish today than back then? Global demand's up 10 million barrels per day since then. So you naturally need more inventories to be in equal status. And at the same time, we've got the end of U.S. hypergrowth. We're looking for growth of about 800,000 to 1 million barrels per day this year, but a fraction of demand growth. But way more importantly, when you look at OPEC, at least for the month of February, 4 of the 7 biggest producers in OPEC were underproducing their quota. And so it supports my belief, at least in my mind, that what you're seeing is the impact of many years of insufficient investment where these nations had to not sacrifice social spending. And the easiest thing to cut was investment in new productive capacity at a time of low oil prices. So the exhaustion of OPEC's spare capacity, I think we were going to see by the summertime. And this is going to be even more bullish than the end of US shale hypergrowth. So you look at the setup entering into the summer, like we're drawing from inventories in the US when we should be injecting them. You look at propane shortages in the US. You look at diesel. I think there's 35 days of inventory of diesel in Europe. Like this isn't just an oil story; it's an oil product story. And so the setup for summer, when demand seasonally increases meaningfully, like we're in the weakest period of demand seasonally right now, and yet we're drawing from inventories. What's going to happen in 4 or 5 months' time when demand seasonally goes up, when we've got a demand surge from all of us wanting to travel now that we don't have to, stick things up our nose and test negative and get my kids quarantined, like all of these different things. What's going to happen then? And so the setup for this summer is looking unbelievably powerful.
Yeah, I think this is really interesting because you're right. There is kind of that expectation from people that, okay, oil and gas companies have been a little bit maligned as we go through this green energy transition. Like, of course, don't they want to increase their production when we need it? So maybe we can talk a little bit more about that. I think you were tweeting a little bit about, Canada's natural resources minister saying, okay, yeah, we can increase our production, but it is up to the companies to decide if they want to do that. You've also spoken about this golden age of free cash flow right now. So can you maybe unite some of these factors and tell us what this all means?
Yeah, so our minister tweeted or gave an interview and said, look, Canada, we're going to do our part. We're going to increase our production by 300,000 barrels per day, 200,000 oil, the rest gas. And I was confused by that because I'm like, well, we don't live, in Russia. Our government doesn't dictate what our companies do. The management teams, the boards, and the owners. I run the biggest energy fund in Canada, and so, on behalf of my unit holders, I'm one of the largest investors in many companies in Canada. And so the backdrop is my average valuation in my fund, I own 14 names, it's probably sitting about 2.2 to 2.3 times enterprise value to cash flow. And these businesses used to trade at 8. We're looking at free cash flow yields in the low 30s. 30% free cash yield at an oil price $8 lower than spot. And so for my businesses, if they came to me and said, Eric, we've got a structural deficit, we think we should be growing oil production. My ask of them would be, well, how do you justify that? When what you should be doing, in my opinion at least, is keep production flat, generate a whole lot of free cash flow, and then use that to become the buyers of your stock. Like how can you can buy your business at, in some cases, 1.6 times cash flow and like a 40% free cash flow. How can you justify anything better using those dollars than buying back your own stock? And I don't think they'd be able to come back with a strong comeback to that. And so, if you look at politicians talk, there's not always substance to it. There was already going to be some modest natural increase in production, here and there, rounding errors for the industry. So was this the grand announcement? No, the minister's taking a report, looking at what we are all going to be doing and then pledging that as support. That's my impression, at least in terms of what happened. But as a large owner of energy businesses, where my unit holders have done okay. Like we're up 186% last year, up about 40% this year. But they need to get paid for the bravery that they showed through the past couple of years and standing in when other people didn't. And so this is our time to benefit from the golden era of free cash flow. the maintaining flat production, maximizing free cash flow from high revenue, low cost structures, as these companies have cut to the bone over the past couple of years, and worst bear market in history. And so the amount of free cash flow that's going to come back to us in the form of buybacks and dividends. So dividends we get paid, buybacks I think forces the re-rating from these stocks trading at generational low valuations to say, okay, if you don't want to buy it, we do. We know the business better than you anyways. And we're going to use our free cash flow and buy back 10, maybe even 20% of our stock through specials. And that I think can act as a catalyst to re-rate these names. You can force the re-rating.
Yeah, makes a lot of sense. So I wonder if we can also talk about, the way that exports flow, right? So if Canada does increase its production or somewhere else in North America does, it where it's needed is over in Europe, right? So if we're putting it over here and it's needed over there, maybe you can just talk about how those flows work.
Yeah. Yeah, so we export 99% of our oil to a single customer. So that's the United States. And so it primarily goes to the Gulf Coast of Mexico, where it's refined into products, and the US exports those products to world markets, which is something that's necessary. We referenced Europe. Like diesel, there's a real issue coming for potential diesel shortages. Canada is expanding a pipeline called the Trans Mountain. It's under delays and cost pressures. We're having to do things like we've moved 150 anthills, we've moved 150,000 frogs and other amphibious beings, and we've even by hand, these people have had to move moss that was in the way, store it, like endangered moss apparently, and then they're going to later, put it back by hand, which is a whole other conversation about people that dare say that Canada doesn't have high environmental standards. So that's been delayed a little. That's coming online late next year, early 2024. That will allow us to expand our export capacity to probably Asian customers as opposed to just the Gulf Coast. So yeah, it's a global integrated, it's not just oil to crude products. US refiners are literally designed to process our crude, which is why killing Keystone XL was just an act of epic energy ignorance on the part of the Biden administration to placate, the eco-woke on the extreme left. And so my hope is, this is a tangent, but that the crisis that we're in now is a teachable moment for energy policymakers all around the world, whether it's Europe, you just realize, well, geez, in some countries, 100% of our gas was coming from one country. They've proven themselves not to be a reliable supplier. US saying, well, geez, we've got a guy to the north that has one of the largest oil reserves in the world, and they produce the most environmental highest standards. Like, why are we importing oil from Russia and some Middle Eastern countries where we don't agree with their human rights levels, where we can get it from Canada? So I'm optimistic. Sometimes I'm too optimistic, but I'm hopeful that this is a teachable moment, and we're going to see some evolution in terms of the thinking of, you and I will be using oil for the rest of our lifetimes. Yes, we're decarbonizing. Yes, we're building up the grid. But when you look at the need for oil and hydrocarbons, it's going to be around for a very, very long time. And so you've got to ask, hey, where do you want it to come from? Do you want it to come from Russia, or do you want to come from Canada or the US? Because if we give up market share, they will take it. And we know, unfortunately today, what that revenue is used for.
Okay. And so I want to talk about the recently launched fund. I think we can tell why you would have launched it during this time. Clearly, you're very, very bullish on the market. So it's a Ninepoint Energy Income Fund. I wondered if you could tell us what it focuses on and also differentiate it from the existing fund that you already had.
Yeah, so I've been running the Ninepoint Energy Fund for, I think, 12 years. It was the #1 performing energy fund in the world last year, and the #1 conventional energy fund in 2019. And so performance has been relatively good. It's been a challenging environment to manage. We're very optimistic where we're going. But I would go to clients or people that I thought they might have an interest. They'd say, well, Eric, we like the fund, we like your style, whatever it is. But my clients are older. They need income, right? The retirement, or they just want income. And so it's something I've wanted to do for years. We've launched it now. We started like 5 months ago, but it happens to be in the golden era of free cash flow, as I define that. And so our goal is, rather than maximizing upside capture, which we do in my Ninepoint Energy Fund. So if you believe, as I do, that we're in a multi-year bull market for oil, I think we're going to see all-time highs. Oil stocks are discounting 60. By my measured upside, maybe there's 100% or more left in energy stocks, et cetera. We've got a vehicle for you. If you're like, I'm bullish on energy, but I need to make a monthly income, we have a product now where we're paying 5% annualized per month. And so we make that yield two ways. One is we're buying dividend energy stocks, but we're doing it in a different way than most people might think. So yes, you can buy a stock making 5% as a base dividend. The real upside now are companies that have adopted variable dividends. So primarily shale companies, some in Canada, where they are doing just a cash sweep on a trailing quarterly basis. And so at $100 oil, we think we can make 9 to 10% per year. But what we're learning is what we thought we're actually putting into practice. The real juice is by writing calls on these positions because the volatility is massive. So as the writer of calls on our positions, people are paying us a huge premium. And so we've been writing 1 to 1 month out calls. That caps the upside. On average, we're capping it at about 13% 1 month. But if you're an income investor, you can make a 13% in a month. And your worst case is you sell the stock 30% higher. Most people are pretty happy. But so far, approximately, we're making 19% annualized returns on writing those calls. And so our portfolio yield now is about 6.4%. But so far, we're making 19% annualized per writing calls. So we won't be able to do that every month successfully. So I'm kind of thinking now, I'll cut that in half. That's 10, 6 from the dividend, 6.5. That's a 16% cash on cash yield, true cash, no return of capital. But right now we're paying 5. So there will be a true up, at least by the end of the year. We're probably going to do a quarterly to smooth things out. And over time, I would expect us to increase that monthly payout. But we kind of want to walk before we run. So it's two different vehicles. One, the income fund is extract as much income as you can through higher commodity prices, gas, oil, by variable dividends, writing calls. And then if you're a Uber bull in oil and you think it's only 4% of S&P 500 and we're early earnings, party's just getting going, we already had what was the very best vehicle on the planet for people. So this is complementary to, it's absolutely not a substitute for what the fund that we've been managing for 12 odd years.
Okay, makes a lot of that sense. Thanks for explaining that. As we're finishing up here, I want to touch briefly on oil prices. So keeping in mind that the situation is changing all the time, it's hard to make predictions. Where do you see prices going in 2022? Is there anything that we can tell at this point about what may happen?
So I think it's a tell that, is there a political risk premium in the oil price right now? I would say no. Volatility is being accentuated by the lack of liquidity on trading houses. A lot of the trading houses, this was a story past couple of weeks. Why did oil crash to like $93? It was that there were margin calls because of wheat, natural gas, steel, oil, all those things. So there was forced liquidation. We've got that over. But I think it means oil is going to be a lot more volatile. So here we have a headline, Shanghai lockdown on oil is down $6. It's like, you're talking, it's 24 million city, but we're talking like a week. It's kind of silly. So it tells you things are just gonna be more volatile. You got to put up with it. But my conclusion for where we are today is we are drawing from storage globally when we should be putting it in. Demand is going to surge because of seasonality and the pickup in leisure travel business by the summertime. And I think the restrictions on Russian exports are only going to get worse, and it's going to aggravate the undersupply, and inventories are going to draw down more. So my theory has always been the oil price is going to have to act as a demand destruction mechanism, where oil has to get too expensive for, maybe not me because I own a lot of energy stocks, but for the average guy to take their family to Disneyland or to rent that RV, that discretionary element of travel, which is at most 30% of total oil demand. 70 is like it's not changing. So the question is, okay, well, what oil price is that? And this is not a forecast. I'm going to reference someone else's work, Mike Rothman at Cornerstone. He would say that we have to get to 6% of global GDP, but importantly for a year. So it's not just where we're going, but it's longevity. How long do you have to stay there to change behavior? His work would suggest an oil price of above $180 WTI. And if you inflation adjust the prior high is about 184. So there's 2 points to triangulate to that point. That's incredibly destructive to the global economy. It's going to be destructive to oil demand. So it's not like that's not what I want to happen. But I'm a guy, my compass is logic and math. And if you're structurally undersupplied, that undersupply is only going to get worse. And I can't identify where short cycle supply can come from. And long cycle investment is dead because of decarbonization, ESG, and divestments and all those other things. And so I was always told early, making a production, give a price or a timeline, never both. So forget the timeline. The price is, I think we have to go high enough to kill demand. And that's meaningfully higher than $120, $130 oil, unfortunately, because this is like, if we just stayed at 100 forever, like that's a very happy place for everybody, even 80, frankly, with stocks discounting 60. But I don't think we're going to get that wish. So I think within the next 1 year, we'll see all-time high oil prices.
Okay, perfect.
Inflation adjusted as well.
Okay, okay. Thank you for that. I think we can wrap up here unless you have any points on the oil and gas market that you want to leave investors with, things that we might not be noticing amid everything else that's going on.
Yeah, I would just bang home the point that we're in a structural bull market because demand's higher than where it was pre-COVID-19, and we've yet to have a demand-related surge. We're in a world where we no longer have the destabilizing impact of US shale hypergrowth, where it exceeded demand. And therefore, there's a call on OPEC, there's a call on global super majors, but it's a call that very soon they will no longer be able to answer. Maybe we're going to get an Iranian nuke deal in the next week to 2 weeks. I've got anybody from like Dr. Anas saying that's a zero, like they're already exporting because Biden's not enforcing sanctions officially, to others saying, well, okay, it's 700,000 barrels per day. It's a rounding error in either case. Venezuela, you're looking at a couple 100,000 barrels per day incrementally. Like these are rounding errors relative to the quantum of the problem that we're facing. And so I don't want people to think that, peace breaks out, the thesis is over, stocks are expensive. My average holding is discounting approximately $60 oil. It's trading at near generational low valuations. This sector is debt-free this time next year. And literally cash is going to be a problem. They literally will not know what to do with it all. And so it's going to be big buybacks. It's going to be base dividends. It's going to be special dividends. It's going to be a wall of cash flow being returned to shareholders. And that I think is going to lead to a massive re-rating in energy stock valuations from where they trade today.
Okay, well, thank you so much for summing everything up. Great to hear from you. And thanks for sharing all the insight.
Thanks very much for having me again.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Eric Nuttall with Ninepoint Partners.